This is Al Brooks. Thank you for watching the Brooks Trading course. This video is on trade management and on taking profits. I'm going to be talking about management, and by management, I mean what you do after you enter a trade. I'm then going to talk about OPM, other people's money. That's a concept that you sometimes hear if you have an open profit. Oh, it's other people's money. And the implication is that you can trade it more recklessly because it's not really your money. But the truth is, once it's in your account, it is your money. Trade management, it's what you do after you enter the trade. Traders take trades for any reason, and they always have a goal, a profit target, and they always have a means of protecting themselves if the goal is not reached, for example, a protective stop. By managing a trade, I mean following your plan. If the price action is doing what you expect, you follow the plan. If the price action is doing something other than what you expect, you have to change your plan. And you always have to be willing and ready to exit, even with a loss. If your premise is no longer valid, you have to get out. For example, we have a double top. We also have a small double bottom here, but we have a trading range with a double top, and we broke above it, and we went sideways. Traders could buy above this bull bar or above that inside bar, and they get long over here on this bar. You have to have a plan. Initially, you might plan to take profits at a measured move up. So the bottom of the trading range, the top of the trading range, and the profit target would be up there. However, what do you do when you get this? You have a strong reversal down, yet the market did not reach your target. Well, what you do is the market clearly has done something very bearish, and the odds now of the market reaching your target are much less. So just exit. You can either exit on the close of this bar or on the reversal up, betting that there'll be at least some kind of a second leg down. Here we got a strong bear breakout, a rally to a lower high, and then we did get a second leg down. We have a pair of consecutive strong bear bars closing on their lows, totally reversing this final bull breakout. So the odds are we're going to go sideways to down, and the chance of the market reaching your target is considerably less. So it's better just to get out. I often talk about the trader's equation. The probability of success times the size of your intended reward has to be greater than the probability of losing times the possible loss, the distance to your stop. You want that to be positive. You need to protect your profits. You need to let them grow. However, you got to take them before they disappear. As far as strict rules go, there are no strict rules. All you have to do is be logical. And anytime you do something that results in a positive trader's equation, you're doing something that mathematically makes sense. So you're doing something that's reasonable and acceptable. In other words, you can do it. We have a bull trend. We have a bull breakout and a pullback. You can call it a wedge bull flag. 3 pushes down, 1, and then 2, and then a pause, and then 3. So it's a wedge bull flag around a 50% pullback. Traders will buy above this bar. It's a small bull bar. When you're not sure where or when you should take profits, always rely on the trader's equation. You can always take profits whenever your profit is 2 times your initial risk. In fact, the math is, I think, based upon actual risk, but you can use initial risk. Here, initial risk, if you're buying here, are you going to put your stop below the bottom of the wedge bull flag? Probably not. We could easily drop another 1 or 2 small legs down, and your premise of a bull trend is still valid. So your stop is probably below the bottom of this bull breakout, like maybe below these bars or maybe below that bar. You enter here, just above this bar. Your initial risk is below the bottom of the bull breakout. 1 times your initial risk is here, and 2 times your initial risk is here. So if you buy here and put a stop here, the math is always good if you take full or partial profits here at 2 times initial risk. If you do this all the time, you will make money. Even if you only win 40% of the time, you will make money. The trend kept going up, and every institution has a way of protecting its profits, and it does not want the risk to be too far. So if you buy here, and your initial stop is here, and the market keeps rising, are you going to keep the stop down here? No, at some point, the risk is too great, and you have to reduce your position, or you can try to reduce your risk. One way to reduce your risk is by tightening your stop. So you trail the stop, you move the stop up, usually to the bottom of the most recent bull trend. Here we have a reasonably strong bull breakout, so this is a major higher low. And once the market is somewhere up in here, traders will say, okay, I don't want to risk all the way down here. My premise is a bull trend. We should be getting higher lows, higher highs, if it falls below a fairly major looking higher low, my premise is no longer valid. So when the market is here or anywhere up in here, a lot of traders will raise their stop to below the bottom of this major higher low. Now, let's say the market is up here and your stop is down here. That's a much bigger risk than when you bought here and your stop was here. When you bought here with a stop down here, you traded with a position size that was appropriate for this size stop. Now the market is up here and you're risking much more. You can say it's other people's money. Fine. I would not say that. I would say my risk is greater than what I want it to be. And can I move my stop up here? I think that would be a mistake. That's a minor higher low. The only other way you can control your risk is by reducing your position size. And when institutions reduce their position size, they're selling out of their longs. So you have bullish institutions now selling. And what happens? You get a pullback. And if the institutions are reducing their position, they often wait 5 or 10 bars to see if the reversal down, the profit-taking reversal down, is the start of a bear trend. If it's not and the market stabilizes, then they'll buy again. You just arbitrarily reduce your position size. Oh, the market's going up. I'm going to reduce my position size. It's usually better to do it at some kind of support and resistance because a lot of institutions will take profits at support and resistance. This is a bull trend. Now, where's the support? Look for it. One way to look for it is look for a gap. We have a bar here, a close above it, and then the low of this bar is at or above that high. And then the same thing here. We have a breakout bar, a bigger bar, and then followed by a bear inside bar. The low of that bear inside bar is above the high of this bar. That's the breakout point, this high, and the pullback is that low, and there's a gap. The trend started either here or here. A measured move up takes us here. And a lot of institutions will take partial profits here. Especially when the trend is pretty strong, they'll often take profits at 1 times the initial risk. At this point, we got this pullback, and it looks like we're forming a gap once we start up again. The stop is down here. 1 times risk is up here. When there's a high probability trade like this, when you're in a breakout, the probability is high that the market's going to go higher. Traders will often take profit at 1 times initial risk. You can also look at it as a leg 1, leg 2 move. We got a breakout and then a small pullback. And then the market started up again. So we have a leg 1, leg 2 measured move. And the profit taking, traders reducing their position size, results in a pullback. Traders need to protect profits and they have to let their profits grow. And you can do that by using initial protective stop. You can use trailing stops. You can use break-even stops. Here we get a reversal down from a lower high with a strong bear breakout and a follow-through bar, and then another follow-through bar and another. Somewhere in here, you have to decide the odds are the market's going to go down rather than up. The market's always in short. A lot of traders will sell the close of either this follow-through bar or this one here. Where's the initial stop? Well, at the top of the initial leg down. This is a strong breakout. It began here. You could put your stop up here, but most traders would consider this a major lower high. If the market gets above this high, their premise of a bear trend is no longer valid. The market would either be in a trading range or in a bull trend. So they'll put their stops above that high. We get another bear breakout here. And what do? Do you still keep your stop up there? Probably not. Traders might put their stop above here. This is the top of this leg down. Or they might simply put their stop above the top of this bear breakout. What happened here? We have a bear breakout and then a bull bar for the follow-through bar. This might be a failed bear breakout and the start of a trend up. We have a bear trend, a protracted trading range, and then a bear breakout. You could call this a lower low major trend reversal. So if you did get out above this bull bar and the bulls failed to get a strong bull breakout and this rally failed to get above this lower high or that lower high and the rally lacked consecutive big bull trend bars, so it looks more like either a bull leg in a trading range or a bear flag, you have to be thinking about getting short again. And you can call this a wedge. There are 3 or 4 pushes up here. There's a first leg up here and then a bear bar, first leg, and then another pause here, second leg, third push, fourth push. A lot of traders will sell the reversal down. I don't have it drawn in, but I could draw a line across the top of this bull channel, and we broke above it and are starting to reverse down. That's another good reason to short, especially since the market is still always in short. Once it starts down, traders will say, okay, maybe I'll put my stop above the top of this bar, because if it gets above that, maybe it's no longer a bear trend, maybe it's a trading range. So they sell here, stop up here, That's their initial risk. Here's 1 times initial risk. Here's 2 times initial risk. Traders might plan on exiting at 2 times initial risk, especially since the past 50 bars are small and the range is small over the past 50 bars. So your target is going to be smaller than traders selling up here where the bars are big and the swing is big. But look what happened. It did not fall below 2 times initial risk and then started to turn up. And so it did not reach your scalper's profit. And what do? A lot of traders will say, well, it's not great. It did not reach my target. It got very close to it. I'm looking for a scalp. I don't want to lose any money. Maybe I'll simply move my stop to break even. Mathematically, break-even stops are stupid. There's no mathematical basis for using a break-even stop. A lot of times, I would simply buy back my short on the reversal up, or I'd leave my stop above the top of the bear leg. But realistically, a lot of traders, when they're scalping, if it doesn't go their way, they'll quickly just move their stop to break even instead of trying to move it exactly above the high of this small bar. A lot of times it's simply easier. If you're using a price ladder, for example, you can see exactly where your entry price is. A lot of traders will quickly move their stop exactly to that price. If you did not exit on the reversal up, and if instead you moved your stop to break even, your stop did not get hit here, the market resumed down again, and a lot of traders would simply try to scalp out at that prior low. And you can see we fell below that prior low. It's around 2 times initial risk, and they'll take profits there. They certainly will exit on the reversal up because this is not behaving like a bear trend anymore. We have a bear breakout here, but a very weak second leg down here, and it looks like we're starting to enter a tight trading range. OPM, other people's money. It's never true. Once the money is in your account, it's your money. I really think it's a pretty dumb concept. We have a bear breakout here, big bar, closing below the low of the past 10 bars, probably a measuring gap, and probably fall from there. So let's say you sell that close, this close of this big bear bar right there. Where's your initial stop? Probably just above the top of the bear leg. You don't want it to get above this bar. If it does, your premise that we're at the start of a bear trend is probably wrong. The market fell and then went sideways. We have a double top bear flag, low 1, low 2, and we went up again here. You can call it a low 3 or a triangle. Does not matter. And then we reversed up here. We have a very good bull bar closing near its high, a very strong bull reversal bar, and we have a potential final flag. Can a beginner hold short thinking that all of this profit is somebody else's money? Can he hold short and say, I don't care if it comes back to my target. I'm not losing any money. That's other people's money. Some beginners will do that. They'll move their stop to break even, hoping that we'll just keep channeling down. No, you cannot do that. That's just totally dumb. Once the money is in your account, it's your money, and you have to protect it. And this is a strong buy signal, so you have to buy. You have to buy back your shorts. And if you're able to, you can go long. Think about this for a second. You're arguing that this is somebody else's money, even though it's in your account. Let's look at it from the other side. Let's say you bought here instead of sold, and the market is falling, so now you're losing more and more money. The money is no longer in your account. Do you pretend that it is in your account, even though it's in somebody else's account? No, you no longer have any control over it. It's not your money. It's in somebody else's account. Likewise, if you sold here, there is money in your account that was not in there earlier. It's your money, and you have to manage it like your money. Doesn't matter if you sold here, or if you sold here, or if you sold here. The management is the same. Management has nothing to do with entry price. It has to do with price action. And it doesn't matter where you sold, anywhere in here. Once you see this bar, you have to get out. As I said, once you're in a losing position, that money is in somebody else's account. It's their money. Don't worry about it. It's no longer yours. You no longer have any control over it. I talked about this as a triangle. You can call it a double bottom. Let's say you bought above this bull bar. 3 pushes down. We went down and up on this bar, and then down on this bar, and then up and then down. So you get 3 pushes down. We have a breakout and then a pullback with a good-looking bull bar. So let's say you bought above this bull bar. It's a triangle. Arguably, it's a reasonable thing to do. And what do? What I would do is I would get stopped out with a loss because I think we're still always in short. So I don't want to be holding long if the buy signal reverses down below the bottom of the trading range. I would just get stopped out with a loss. If I lose, I don't look back and say, darn, I feel bad. I shouldn't have done that, or I wish the market didn't do that to me. I wish they didn't take my money. I never look back. When I'm trading, I always look forward. I'm only interested in what hasn't happened yet. What has happened, it's over. It's history. I cannot change it. And if I'm looking back, I'm going to miss the next great trade. So if I'm at this point saying, darn, I just lost money and I just feel bad and I'm going to take a break from trading, and then you miss this. You cannot do that. You have to not feel bad over a loss. You're going to lose. Everybody's going to lose. Even a great scalper is going to win 90% of the time. That means he's going to lose 10% of the time. And if he looks back at his losses and is dwelling on them, thinking about them, he's not going to be mentally prepared for the next trade. And sometimes it's a great trade like this. A strong final flag reversal with a great looking bull bar. That's a great trade. You got to take it. If you don't buy here, you're going to start buying closes somewhere up in here. And if all you're thinking about is, darn, I lost money, well, you miss a great opportunity to make back many more times than what you lost. Take a look at this slide. Let's look at the bear side of it over here. There are many reasons to get short on the way down. We could sell this as a double top bear flag. Here we have an exceptionally big bear breakout. We have another one here. Here we have an attempt to reverse that is weak, so a lot of traders will sell at a limit order at the high of this bar, betting the bull reversal will fail. And then here you can call this a double top bear flag. You can call it a low one bear flag. Traders will sell there as well. It doesn't matter which one of these entries you took, your stop is still going to be the same up here above the top of the bull leg. Some traders sold early on, other traders sold late. It does not matter. All of those bears are going to manage their trade the same. And all of those traders have to get out above this bull reversal bar. This is a strong buy signal, so traders must exit. It does not matter if you shorted right here and you're thinking, oh my gosh, that's not enough profit, I don't want to get out. You're going to get out because that's what you have to do. The market is telling you that your premise of a bear trend is no longer viable. You always have to manage your trades based upon the current price action. All that matters is, where's your stop? Where's your target? Is the premise still valid? And for all of these entries, you have to get out right here. Your stop is up here. Maybe after this bear breakout, you might lower your stop to here. But in any case, this is a good buy signal and you have to get out, no matter if you sold here initially or if you sold up here. So entry price has nothing to do with trade management. All that matters is the stop location, the target, and whether or not your premise is still valid. In this video, I talked about management, which is what you do after you enter a trade. I then talked about other people's money, and it's a stupid concept that's never true. Anytime money is in your account, it's your money, and you have to manage it like any other money that you own. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This video is on trade management and taking profits. This is Al Brooks. Thank you for watching the Brooks Trading Course. This video is on trade management and on taking profits. I'm going to be talking about management, defaults that traders can use when they're deciding how to take profits. Obviously, you want to take profits before they disappear. And you have to have a goal when you enter your trade. And then you adjust your goal as you see the strength of the move. For example, let's say you sell this bear breakout down here, hoping that maybe we'll get a measured move down. So leg one, pull back leg two, or simply a measured move based upon the height of the bear breakout, pull back, and then measured move down. Let's say you're hoping for a measured move from the open of the first big bear bar to the close of the second big bear bar, and this is 1 times that move. It's a reasonable target. And then you see the market reversing up strongly before it gets to your target. Should you wait and let your stop get hit, hoping that the target will eventually be reached? No. The premise of a measured move down after you see this reversal and the market going above the high of that strong reversal bar, your premise of the measured move down is no longer valid. So you have to exit. We got a strong bear breakout. You might trail your stop up here. And then we get this strong bull reversal bar. Most traders will get out above the high of this bar. Should you just get out on the close of this bar? I would not, because sometimes you get the strong bull reversal bar, and then the trend continues down, and the market does not go above the top of the bull bar. So I think you move your stop to above the high of this bar, thinking that it's a valid buy setup. So bulls will be buying there, bears should get out there. You just exit, and your premise of a measured move down is no longer valid, so just get out as the market reverses. Remember, you have a final flag, and then you get a reversal from the final flag. The bulls are going to be buying this. They see a bear trend, a trading range, potential final flag, a trading range late, and a bear trend, and then a very strong reversal up. So bulls are going to be buying here. Most traders who buy this reversal will put their stop down here. So their initial risk is from just above the high of this bull reversal bar to just below the low of that bar. So that's their initial risk. This is a reasonably high probability trade. You do not have to hold for a profit that's 2 times your risk. You can get out with a profit that's just 1 times your risk. You buy above the high of the bull bar, stop below, and this is 1 times that risk. And that is reasonable to get out there. Reasonable does not mean ideal. Just because something makes mathematical sense doesn't mean that it's the best choice. Mathematically, it's always good to take part off at 2 times your initial risk. So this is 1 times initial risk, and this is 2 times initial risk up there. I'm talking initial risk. The trader's equation uses actual risk. So if you buy just above the high of this bull reversal bar, and let's say the market just kept going straight up, your actual risk may have been 1 tick, or 2 ticks, 3 ticks. If you're trading Forex markets, it may have only been 2 or 3 pips. However, with the bars this big and the reversal this strong, you do not want to be getting out at 2 times your actual risk. If your actual risk is only 2 ticks or 2 pips, you don't want to be exiting with just 4 pips profit. Most traders would base their profit target on initial risk, which is below the bottom of the buy signal bar. You could get out mathematically. This would be okay. It's the top of a trading range. High enough probability, strong enough momentum up. Look at this. We have 6 consecutive bull bars up here. Do you really want to be exiting at 1 times your initial risk? While mathematically it's reasonable to get out at 1 times initial risk, the context is good for probably a couple legs up. And at this point, we only have 1 leg up. And with the 6 consecutive bull bars, the probability is we're going higher. So most traders should take their profit at 2 times the initial risk, or at least partial profits up there. I talked about actual risk. I'm saying actual risk is to below the low of this bar. It might not even be there. We get the reversal, you buy above the high of this bar, so you get filled right here. And the market may not have pulled back there. But let's say it did pull all the way to the low of the bar and then went up. So your actual risk is only that big. It's a strong reversal, high probability of making a profit, so you could always exit at 1 times actual risk. Mathematically, it would be okay to buy here and exit there. And if you do that 100 times, you will make money. It's a high probability trade, so 1 times actual risk is mathematically reasonable to do. However, just because it's mathematically reasonable doesn't mean it's the best thing to do. It's rarely the best thing to do. When the actual risk is small like this, and the probability of a big profit is high, it's much better to go for a bigger profit. As long as the trader's equation is positive, you can always exit using that target. I talk more about this in the video on actual risk. While it's okay to get out at 1 times actual risk, when there are obvious targets that are better, more profitable, with still good math, still a good trader's equation, it's better to be looking at them. Let's say you held long and you were planning on getting out at maybe 2 times initial risk. Initial risk here, you buy here, risk is here, 2 times initial risk is somewhere up here. And then you see this. We broke out and we pulled back, and this is a breakout test of that high. I don't know if this slightly overlapped that. It doesn't matter if it's a slight negative gap. By negative gap, I mean the pullback slightly overlaps the breakout point. It doesn't matter. It's still a possible measuring gap. So from the low here to the breakout test here, you project up, there's 1 times the risk. And that would be a reasonable target. So buying here, you could get out 1 times actual risk, or you could look for other targets based upon the price action, and it would be reasonable to buy a measured move up based upon the height of this leg down, especially once you have this breakout test reversing up after testing the breakout point. You have a good chance of a measured move up, and this would be a good location to take profit. Obviously, a positive trader's equation because it's far more than 2 times actual risk. Again, it's always mathematically acceptable to take profits at 2 times actual risk, and that means it's always acceptable to take profits at 2 times initial risk, which is greater than actual risk. So let's say actual risk is to just below the low of this bar. It's probably less. It probably did not go down here after triggering the entry. Then this would be 2 times that risk. Here's your actual risk. Here's 2 times your actual risk. So it would be okay to take profits, full profits, 100% of the time here. Initial risk, here's your entry price. So you risk from there down to here. and this is 2 times initial risk. So mathematically, it's okay to take profits at 2 times there. One choice is, if you want to take bigger profits, is maybe take half off at 2 times actual risk. So actual risk, 1 times actual risk, 2 times actual risk. Take half off here, and take another 25% off maybe at 3 times actual risk, and then let the remaining 25% go as long as the trend is valid. And you could use the same logic to initial risk as well. Maybe take 25% off at twice the initial risk, and another 25% off at 3 times the initial risk, and swing the remainder and get out if your premise looks like it's no longer valid, maybe after the close of 2 big bear bars or 3 big bear bars. We have a huge bear breakout, high probability of lower prices. This is the euro versus the dollar, a 15-minute chart. Probably going to get a spike and channel down. Let's say you sold the close of this bar, and your initial stop is at the top of the bear breakout, and it's about 95 pips above. So your initial risk is 95 pips. If you typically risk 20 pips on 100,000 units, and this risk is 5 times bigger, you have to trade 5 times smaller. So maybe you trade 20,000 units. So you sell 20,000 units. Alternatively, you can argue that this bear breakout is so strong, the market should not get much above a 50% pullback. So maybe put a stop slightly above a 50% pullback. 50% pullback maybe here, put your stop slightly above. In that case, you could trade a little bit bigger, maybe 40,000 units. Strong bear breakout, probably going to get a measured move down, maybe based upon the open of the bear breakout to the close of the bear breakout. Measured move down would be somewhere down there. At this point, I think probably a 60% chance we're going to get around a measured move down from the open of the first breakout bar to the close of the second breakout bar, and this is the measured move down. Probably, whenever I say probably, that means I'm at least 60% certain. If you plug 60% into the trader's equation, you can exit at 1 times risk and have a profitable strategy. 1 times risk means bad risk reward. Your reward is only as big as your risk, and that's not a strong risk reward profile. But that's always the case whenever you have a high probability trade. When you're selling down here, some institution is buying, and they know that the probability is they're going to lose money, but they also know that they're going to have a pretty good risk reward profile. They buy here and maybe put a stop here, maybe even a stop down here, and plan to scale in, buy more lower. You're getting high probability, they're getting low probability, but they're getting reasonable risk reward. We have another bear breakout here, so traders might lower their stops to above here. Strong enough breakout to expect at least a little bit more down, at least another leg down. We have another bear breakout with follow through here, so a lot of traders will say this is a major lower high, and they'll trail their stop down. Initial stop is up here, and then after this breakout, they trailed it down here. After this breakout, they trail it here, just above the top of this bear leg. Same thing here. Another bear breakout, stop is up here. Do they get out here? We have a micro double bottom, and we're trying to reverse up. We have a series of bars in a bull micro channel, no pullback. Well, you could get out above that bull bar, or you could rely on your stop. You could say, well, we got close to the measured move target twice, and we're reversing up. Maybe I should get out here. That is reasonable. It's also reasonable to hold and then get out either at that low or at your initial target. There are always other reasons to exit as well, but you have to look for them. For example, you could draw a channel, this pink line, and this is at the bottom of a channel. Or you could say 3 pushes down, 1, 2, and then 3. And it's almost to the measured move target. We're very close to it. We have a big bear bar late in the trend. In fact, this is the biggest bear bar probably in the past 40 or 50 bars. So you have to be thinking that it's probably an exhaustion gap, which means we're probably going to close the gap between the close of this bar and the close of the prior bar. Usually what it means is the market's going to get to the top of the bear bar. And here we have a low one short, a breakout pullback short, a breakout and a pullback, but not a particularly strong looking sell. Because it's a weak sell and we're at the bottom of 2 channels and we're right near a measured move target and we have the biggest bar late in a bear trend, this is a weak sell setup. Bulls will buy below that bar, betting that the bear breakout will fail. And if bulls are going to buy, it's reasonable for the bears to buy back their shorts, even though it's not a clear bottom. You could continue to hold short, but most traders would end up taking profits at a new low, especially since it's at the measured move target. So there's very little left to gain by holding short. Here, we got a pretty strong reversal up. Why did we get that strong reversal up? Because the final bears bought back their shorts. It hit their target. The trend was weakening. We have a potential exhaustion move here. We have a decent rally here. And bears see that, so they think there's not much left to the trade. If they did not buy back their shorts at the target, they'll buy back their shorts on the reversal up. It's a lower low major trend reversal. Let me look at the math a little bit here. Initial risk was to above the high of this bear breakout. So they're initially risking about 95 pips if they sell here. Actual risk was only 9 pips. You sell this close, it rallied 8 pips. You stop us 1 pip above, so your actual risk is only 9 pips. If a bear exited here, he would have 77 pips profit. Because the breakout was strong, once we started down, you can see your actual risk is 9 pips. After a strong breakout like that, you knew there was at least a 60% chance of making at least 1 times actual risk. And you could exit at 1 times actual risk. So there's your actual risk. You can exit 1 times actual risk. But just because something is mathematically reasonable doesn't mean it's the best choice. Also, remember, it's 9 pips. Do you want to be taking a 9 pip profit? Of course not, because when you're scalping in Forex markets, all of your trades should be at least 10 pips. That's the minimum scalp size. Scalping for less than 10 pips is rarely going to be a profitable strategy. This is 1 times actual risk. So you sell here, theoretically, you could get out down here, but that is, I think, not a very good thing to do. You should avoid taking small profits when there's a big move that is likely. Actual risk can be used to find a minimum target, but minimum does not mean the best. So if you think there's a probability of a big move, don't exit at 2 times or 1 or 2 times actual risk. When you see a strong breakout like this, there's a 60% chance that breakout will lead to a measured move. Even if it's mathematically acceptable to scalp out either here or here, that does not mean it's a good thing to do. In fact, you should not do it. I'm talking pips. When you trade Forex, you're always talking about pips. If you search online, there are lots of Forex profit calculators. You can use them to estimate the profit in US dollars. And that's not only for the euro versus the dollar, that's for any Forex product. For example, the euro versus the yen. You can plug in the number of pips and the prices and the unit size, how many units you're trading, and the calculator would tell you how many dollars. For example, here, if you ended up exiting down here, you sell here, you exit here, you made 77 pips profit on 50,000 units. And if you plug it into a Forex calculator, profit calculator, the profit would be about $485. Now, instead of selling 50,000 units, let's say you sold 500,000 units. Then your profit is about $4,800, close to $5,000. And the reason I bring that up is because $5,000 is a magic number for traders. Because if a trader is able to average $5,000 profit a day, that translates to about $1 million a year. If a trader is starting to become consistently profitable, they start thinking about making $1,000 a day, $2,000 a day, and then they realize that, hey, if I make $5,000 a day and I trade 200 days or 200 plus days a year, that translates into $1 million a year. So $5,000 is a magic number for traders. Here we have a rally, and then we gapped up on the open. And the market tried to reverse down, bear bar. It tried to resume up, and then it tried to reverse down again a second time. So this is a failed breakout above yesterday's high and a second entry short. That's a 60% probability trade of making money if you take that short. Second failed breakout above yesterday's high, and you have a decent sell signal bar, so we're probably going to go lower, and we'll probably make at least 2 times the initial risk. And then look what takes place here. A tight trading range late in a bear trend is possibly the final bear flag. Tight channel, still always in short, but you might get a couple legs up. Here we got one and not a second. Because of the possibility of a final flag and 2 legs up, it's okay to take partial or full profits above the high of this bar. Why is it okay to take profits here? Well, you got a potential final flag. Odds are, very tight channel, the reversal will be minor, which means either a bear flag or a trading range and then more down. But it's okay to take profits here. You have a potential final flag, and look at your profit. You have 7 points profit, which is far greater than 2 times actual or initial risk. So you have a strong trader's equation. The math is okay to take profits here. Tight bear channel, probably going lower. So it's also okay to hold short. Probably better to exit here, or maybe here. It's about the same price. Here we got a double bottom, and we're converting into a tight trading range. So instead of a tight bear channel, now we're in a tight trading range here, 10 bars here, 20 bars. And at this point, you got to be thinking about the possibility of trend reversal up being almost as likely as trend resumption down. So I would get out here or here. So you made 7 points profit. If you get out here, you made 7 points profit. And if you traded 1 contract after commissions, that would be about $345. If you traded 20 contracts, that would be about $6,900. $5,000 is a magic number for traders. There are over 200 trading days a year, and if you average $5,000 a day, that translates into $1 million a year. When traders are beginning to increase their positions and their profit, so they make $1,000 a day, then they make $2,000 a day, what's the next target? $5,000 a day, because it translates into a very big round number profit at the end of the year, $1 million. Every trader has a dream, right? And you're paying attention to goals, and one goal is $1,000 a day, another goal is $5,000 a day. In this video, I talked about defaults to use when taking profits. The minimum default is always 2 times actual risk, but sometimes the actual risk is small, and then traders should instead think about using 2 times initial risk as their minimum target for taking at least partial profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This video is on trade management and taking profits.